I recently did a video where I looked at a slide from LMND Investor Day and compared their next 5-year projections to my own model to see how realistic they were. And I showed in that video with some pretty reasonable assumptions, you can actually get quite close to these numbers. But in this video, I want to show what happens in the following years after they reach profitability. What happens after 2027 if this model continues? What happens in the next, say, 3 years up to 2030 after they reach profitability? So let's take a look. In 2027, I have an adjusted EBITDA right now, how my model's played out. I have adjusted EBITDA of $98 million. Very, very close to what LMND is projecting and showing from their investor day. And again, if you want to see how we got there or got to that, watch that other video, which I will link. Now, of course, I should warn, there's a lot of uncertainty in all of these numbers. We're trying to project more than 5 years out, but we're going to do the best we can. And I think this is reasonable. So let's have a look. I'm projecting after they reach profitability. So say they have this profitable year of 2027. Then as we move into 2028 into the sort of realm of profits, I'm projecting they push into more customers. So they're really aggressively growing and using any cash they have to push customer growth. So before, in the last few years, I had slower customer growth, maybe 3% quarter over quarter, 3.5%, and more premium per customer growth, basically meaning they're expanding out their product lines where they currently are. Current customers are trying to upsell to more products as they bundle more products, basically until they reach profitability. And then I'm proposing they may shift that strategy, of course, continuing to build out those lines where they can, but also pushing into new areas where they can get more new customers. And of course, as they have more products, you have more product on-ramps for customers to join LMND. Maybe they don't need renter's insurance, but they have car insurance, and now it's available in their state and available for their vehicle, and they get car insurance. So they could all be part of that on-ramping. But of course, LMND also has these niche products or more niche products like renter's insurance, and they can do that profitably and efficiently. So that's their advantage. They can grow in new markets, potentially even new countries, and capture new customers or young customers once again where you're competing with in a less competitive space where you're competing for renter's insurance and you grab those customers. So I'm projecting higher customer growth, but then less premium per customer growth because I'm assuming more of the new customers coming in the door might be the lower ticket items potentially. And then over time, they're going to grow with them and a lot of those customers will have more premium. So anyways, that's what I'm projecting over the next few years, 7% quarter over quarter. Basically means that 2027, we have about 3.5 million customers. And then by the end of 2030, we go from 3.5 to almost 8 million. So massive growth in customer count over the next 3 years. Of course, this is just how I'm projecting. It's going to be totally different from how this actually plays out, but I think these are reasonable assumptions and thoughts. Premium per customer, I have at $828, and then that's moving up by 2030 to $1,050. By the way, if you want full access to this model, it's on my Patreon, and I'll be continuing to post exclusive content there. So if you want to support the channel, feel free to join my Patreon there. And in-force premium, about 2.8 billion, 2.9 billion, and then by the end of 2030, really exploding up to $8 billion. So what I'm really trying to show here as you're shifting from profitability, and we'll get to the bottom line in a moment, you may not realize this at the time, but if they reach this profitability scenario, I think their profits are, the 100 million or so that they did in adjusted EBITDA in 2027, that's going to explode off of the page over the next few years. A really pivotal time. So going from 2.8 billion IFP up to over 8 billion just 3 years later. So massive growth, even at the larger scale they'd be at then. Reinsurance, once again, I have structured in a similar way to it is now. That could be changing over time. We'll see how even in the next few weeks likely so their reinsurance renewal will come out. We'll get more details on that, but I've left that the same. Gross loss ratio I have at 72%, and then moving down to 70% and 70% all the way to 2030. So 70% for those next 3 years. We look at annual dollar retention and my sales and marketing and my customer churn from 12 months prior, which is not something that LMND releases, but I just calculated from their premium per customer growth rate and their annual dollar retention. This is how I forecast it. I assume that they're going to have 20% customer churn from 12 months prior. So 20% of the customer base at any given time 12 months later is churning out at this point. And then from that, you calculate all the new customers you gained plus all the customers you gained to overcome the churn customers, and you give a $200 customer acquisition cost, and that gets your sales and marketing costs. So this is kind of how I calculate all of this. You're going from 20% churn in 2027 and slowly trending down to 19% in 2030. These years after, don't look at some of these numbers like I have 16%. I haven't really detailed out those numbers as closely as up to 2030 I did for this video. But again, sales and marketing as a percent of gross earned premium actually spiking here. It goes from about 8%, 7% up to 10% in this quarter, and that's because I'm assuming they're going to more aggressively push into growth mode, especially as they become profitable. Maybe even sooner than that if they say their stock price soared in the next 5 years and then they raise more capital. Maybe they would even push that sooner, but in this scenario, that's why I'm seeing that play out. Goes up to 10% and then slowly trends down again to 8% by 2030. Other insurance expenses, I have some modest growth there, but slowly having some operating leverage, going from 5% to 4% of gross earned premium. Tech development, again, 4% down to, as your IFP really explodes and your gross earned premium really explodes, that really can track down because your tech development should be one of the metrics that really has operating leverage under it. G&A, again, I have modest growth, basically 2% per quarter as you're growing. Whether that's realistic or not, I'm not totally sure. You have that growing to the basically 3% of your GEP by the end of 2030. So again, then total expenses again are rising a little bit from 23% to 25%, then tracking down by 2030 to 17% of your gross earned premium. I think they would get even better than that over time. Your combined ratio, I recently just added this to my model. So combined ratio, if you're not familiar, is basically your loss ratio, which is what you're paying out of all your premiums to your customers who have losses, and then your expense ratio is all your other expenses out of that premium, what you're paying there, and then your combined ratio is what the two are combined. So at this point, I'm at 98% combined ratio as they reach profitability, 95%. So that means, every $100 of premium, there's $5 of operating income, and then that's trending down. By to 2030, I'm at 87%, so massive 13%, profit there versus 2027, we're talking 4 or 5%. That's why you're going to see, again, the profits really explode out of this pivotal year. That's how I'm modeling it. That's how I'm seeing it. Stock-based compensation, again, I just kept it at $15 million per year. And then you see your adjusted EBITDA. So again, by 2027, we're at about $100 million. 2028 for the full year, we're at $165 million. 2029, we're at $376 million, and 2030 we're at close to $700 million. So you go from 2027 and then 28, 29, 30, 3 years later, you have a 6.9x increase in adjusted EBITDA profits. 6.9x increase over 3 years. 6.9x increase over 3 years. That's a 90% compound annual growth rate in your profits. 90% over the next 3 years. That's because the base profits that we're kind of looking at in this 2027 scenario are relatively small. Just kind of barely reaching profitability, and then you're creating this pivotal point for the company where you're exploding into more profitability. This is why actually I said in that video, I had a PE around 2027 of like 150 or 145, and a few comments of people saying like, oh, that's way too high. Or I mentioned like maybe the PE might even be like 300 at that point. And some people were like, no, that doesn't make any sense, bro. Like you lost me when you said PE of 300. But people don't understand. PEs, it's very hard to sort of encapsulate a normal PE at this point in the company because you're at this pivotal point where your profits are exploding. So if you look ahead like to 2028 where the profits are going, and I added in a PEG ratio, which is a PE relative to your growth rate of earnings ratio, and we're at here, it's bouncing around a little bit based on how the earnings are fluctuating here in a quarterly basis. But if you look ahead, I mean, we're kind of PEs of, or a PEG ratio of 0.99, 0.56, 1.37, 1.71. I actually should make this based on a trailing 12 months, would make this a little more of profitability, that make it a more smooth PEG ratio. I will adjust that for future videos. But you can see it's not a crazy, even at a PE of a punching in, like starting at 300, and then by 2028, we're still a PEG ratio of, 1 point something, or even around 1, sort of fluctuating around there. So it's really not unreasonable that the PE ratio might be a few hundred, 200-300 at this point. And if the price to in-force premium ratio, I started at 4 and I'm slowly tracking that down, that might get you a market cap of 13 billion by, the 12 to 15 billion, 16 billion by 2028. And if you look at it in this sort of PE realm, depending, again, there'd be tons of arguments that this should be higher or lower, right? But I'm just putting some number in so we have some comparison or some idea. For the PE, you're at 276, and the market cap here is actually less than a 3.9 price to sales ratio. So you're at like a 9 billion up to 35 billion, somewhere in that range. And then if we look forward to 2030, I've slowly sort of trended these down. You're still in the lower end, maybe 25 to 30 billion dollar range, and the upper end you might be like 80 to 100 billion dollars or more by 2030, which would be insane, but not impossible, I don't think. Depends on the market would value them and the sentiment at the time. And here's a graph of those two plots we're making for the market caps. So by 2030, you're somewhere in this range of maybe 100 billion, or by the end of 2030, maybe 100 billion or more than that. At the lower end, maybe 30 some billion. Obviously, massive returns from where Lemonade is at right now. Of course, say they're at 30 billion market cap, that's a 21x over the next, say, 7 years time. So I just punched that number in. It's about over 50% compound annual growth rate. And of course, if this is like 100, I mean, you're talking like an 85% compound annual growth rate, right? So just ridiculous possible returns. We don't know the future, even if it was $20 billion company at that time, and you're at a 14x of what you are now, and say that happens in 7 years time, you're still at like a 40-some% compound annual growth rate. So it's crazy good no matter the outcome anywhere in that range. But I'm just trying to show, and I'm not trying to exactly predict what that number could be. I'm just trying to show that anything in that range is crazy good, and I feel like the assumptions we made to get there are reasonable assumptions. And this is operating income, not adjusted EBITDA income. It does help illustrate, you see in 2027 where you're just barely profitable, and then by 2030 even you're really exploding the profits. You're talking about, if you added up 4 quarters here relative to adding 4 quarters here together, it's a factor higher in the amount of profits you're making. And of course, we could even push this out further. The scenario, say the Lemonade could keep growing, because even at 2030, where we're only talking about, there's how many billion, there's like 8 billion or so people in the world, and we're talking about under 8 million customers. So insurance is just such a massive market with so many countries and so many places that Lemonade could go and expand their marketplace and take market share, that the growth potential is just so huge even beyond this. And even the premium per customer, you say, if they're just even still more within in some of the countries they're currently in, say UK, a few countries in Europe and the United States, the premium per customer could still grow significantly beyond this as they mature their current customer base. But my feeling is they would aggressively expand. Another thing I want to note is that in this model, by the end of 2030, I have a 1.8 billion cash on hand. And as this cash pile continues to grow, I would expect their investment income from this cash would become more and more significant, which I haven't even factored into this model yet, but I will be adding that in. Let me know in the comments what you think of all this. I'd really love to hear your feedback. You can also hit me up on Twitter at PaperBagInvest. Thank you so much for watching. Remember, it's in the bag.